Berkin Kologlu, in your Angel Oak multi-strategy income fund, you have a lot of non-agency residential mortgages, about 60% of the portfolio. Why is that? Do you think the housing market's going to be that strong?
We do not expect it to be as strong as last year. Last year we saw around low teens type increase in the housing market. We think it'll probably be more like 5% this year. However, in the world of fixed income today, to be able to get 5% type yields in a product that avoids interest rate risk is something that we think is still very special, and that's why we're overweight that sector.
Why not overweight agency bonds? What's wrong with Fannies and Freddies?
Well, agency mortgages are long duration fixed income products, so they're very sensitive to interest rates. While they are government guaranteed, you're going to see the price move around a lot, and if rates move up, the price is going to move down a lot, so we are avoiding that sector for that purpose.
And about 20% of your fund is in CLOs. Why is that? Is corporate America very strong? Is that how you see it?
We think fundamentals in corporate America are strong. We think corporate balance sheets are, the leverage there is still within historic averages. Corporate borrowing costs are very low because rates are low and spreads are tight. So these companies are going to be able to service their debt easily and avoid defaults for some time.
And CLOs are traditionally better in a rising rate environment because there's a lot of floaters in there, right?
CLOs are all floating rate. They're all LIBOR-based floaters, and the underlying asset are bank loans, which are also floaters.
Now, just to revisit the credit crisis, it hasn't been that long, a lot of the CLOs and the CMOs turn toxic because they're made up of other loans and a whole lot of mortgages. How do you make sure that yours are not toxic cocktails?
There's a very important distinction here because everything was painted with the same brush. What caused all the huge losses during the crisis were CDOs backed by subprime mortgages. That is what we are avoiding here. Our non-agency portfolio is the cleanest of the sector. It's prime and Alt-A. We avoid subprime. CLOs themselves performed very well during the crisis. Even though there was a spike in default rates in 2009, the structures withstood this very well, and they've all recovered, and we expect, we're very confident about principal and interest return on all the investments that we make.
All right, thanks a lot, Berkin.
My pleasure.
And thank you for watching The Street.